folks. It's Dave Burrows, Chief Investment Officer and CEO here at Barometer Capital Management. I wanted to welcome you to another one of our Barometer Weekly Barometer Readings webcasts. Here we are, we're in the middle of July. We are most of the way through the first 2 weeks. I was away last week, so no webcast last week, so lots of stuff to catch up on. It tends to be that the first 2 weeks of July are pretty positive. In general, they have been. Certainly the major indices are looking pretty good. We have quite an interesting market. There's definitely some haves and definitely some have-nots in the market. And so we're going to take a look sort of from the top down at what we see going on inside our world, what we're doing in our portfolios. If you're a client, we're happy to have you on for this sort of weekly review. If you're not, welcome. Glad to have you with us as well. I'm going to open it up to some questions at the end of the session. So if you've got a question, don't hesitate to tap it in the chat or the questions and answers. And I'll do my best to answer your questions at the end. So you know, the weather is warm, and so are some of the stocks in the market. We've had a view that we've been in a structural bull market in equities in the US since 2013. And when we look at the period from 2013 to present, we've had a series of cyclical advances that have lasted 2-3 years at a crack. And in between, some pretty sharp short pullbacks into the 200-week moving average. Most recent one went from December 21 through January of 24. And as we talked about, when you finally do exit and make a new high, it tends to be you get, you know, like some pretty good running room in front of you, 2-3 years. It tends to be you get a lower volatility period with fewer corrections. When the corrections come, they tend to be shallower. It generally is because people have been shaken out of the market and are waiting for their opportunity to get back in. Most people don't get in sort of early on. They wait for the market to show them that they're wrong, and then they wait for pullbacks, which sometimes just don't come. So it's always interesting. I spend a lot of time on Twitter, and there's all kinds of folks who want to highlight how it's just terrible the way the market hasn't pulled back and it makes no sense. But the fact is there's a lot of money that's stranded on the sidelines. And ultimately, it tends to be that money starts to chase the market at some point when people get behind. So as you know, our view was that we put in a low and it was important in October of 22. So here we are now 18 months later, and the market's working its way higher. Since the beginning of this structural bull market, the S&P is up 268% over 137 months. You know, that sounds good, but we go back and look at the 80s and 90s, it was 1,300% over 217 months. Either way, in time or price, it could be that we have, you know, significant running room in front of us. So we can only take it day by day, and we can only look at the information that we have at hand. We always are looking for new information that presents itself. Ultimately, all of the information out there finds its way into the market at some point, maybe not in the most efficient way. And it's our job to recognize change and to try to make sure that we stay in tune with what's going on from a market perspective. When we look at the S&P over the last 2 years, you know, a very clear trend. US indicators turned higher in the fall of 23. Great run into the spring. Market corrected a little in April and May. It's about a 5% correction. Then May was about a 5% bounce and on to new highs. And since then, the S&P is working its way higher. Now, it's not everything that's working, to be clear. There are some real workhorses in the market. Some of the very biggest companies are providing a lot of the return. And you can see that when you look at the same universe of stocks, but an equally weighted basket. This is the equally weighted S&P 500, and you can see it made a high in March. And since then has been meandering sideways in this sort of tightening range. Now, as I highlighted a couple of weeks ago, markets correct in two ways. They correct in price. Prices drop, things reset, they move forward. Or sometimes they move sideways for a period of time until ultimately the overbought condition gets worked out and we move on. So we're always looking for clues. And one of the interesting clues is we've talked about how technology has been very strong since about February. This is a point and figure chart of the NASDAQ equally weighted index. So like the S&P 500, the NASDAQ 100 have been driven by a small number of stocks as well. But this is looking at it on an equally weighted basis on a point and figure chart. You can see we made a high, we pulled back, we made another high, we made another high, we pulled back, we came back, made a lower high. Same sort of consolidation range that we've seen in the equally weighted S&P. Although in the last 2 weeks, we've now broken out and taken out all of these highs. So if we look at the chart itself, a very similar sort of wedge or pennant formation that we see in the consolidation, but the NASDAQ 100's broken out to new highs. So that is one universe of stocks, and it tends to be tech weighted. But having said that, the average stock in the NASDAQ 100 is now making new highs. So when we have a period of time where things consolidate, like we have been in the equally weighted S&P, it tends to be at some point you break one way or the other, higher or lower. And it may be that the NASDAQ 100 is giving us a clue as to which way ultimately things are going to break. Our view is we're very early days in the cyclical bull market. We've likely got a long way to go. On the other side, there are people who are concerned about economic data, slowing employment data, some weaker GDP numbers, some weaker producer prices. But the market seems to be supporting certain groups. Now, when we look at the correlation between the S&P 500 and the number of advancing stocks, we can see that the number of advancing stocks relative to what's happening in the index is very low. In fact, you have to go back to the late part of the 1990s to have seen such a concentrated market. We highlighted a couple of weeks ago, that it's a small number of stocks beating the S&P, which means it's a stock picker's market. You can't just go buy the index or buy a broad basket. You probably want to be pretty focused, because really only about 25% of the stocks as of the end of June were beating the S&P. We'll see whether that starts to expand, but that's a low number, which means there's a lot of money managers pulling their hair out if they're in the wrong stocks. If we take the 5 largest companies in the S&P, they currently equate to 28.9% of the index. And you have to go back to 1964 to have had as much return come from a small number of stocks. And at that time, the top 5 were AT&T, General Motors, Exxon, IBM, and Texaco. By the time the market evened out in the early 90s, we got to a point where in 1993, the top 5 stocks were only 10% of the index. So this does swing back and forth. Just because they become a large part of the index doesn't mean they have to become smaller, but we watch that, right? We do own Microsoft, we do own NVIDIA, Alphabet, and Amazon. And you sort of have to in this market, given the big themes that are in play. Certainly AI is a very important one, and one that we're trying to take advantage of. Now, we've talked over the last year or so where ultimately, when in purple, global stocks started to outperform, it tends to go on for a long time. It doesn't mean that it starts in a hurry. And when they underperform or US stocks outperform, they tend to outperform for a long time. We've had big outperformance in US stocks over the last number of years. Well, so I just keep this chart to put up from time to time. This is the MSCI All World Index versus the equally weighted S&P. And what you can see is if you go back to 2022, late in the year, now global stocks on average have been outperforming the equally weighted S&P. So this is one of the reasons that we've had an interest in broadening our scope and our equity exposure beyond the US, beyond Canada. Japan has been a topic of conversation for the last year after a 30-year bout of disinflation. The Japanese stock market has burst higher. And you can see these are monthly bars. This month we are trading now the Nikkei at a new all-time high. India has been on a multi-month tear and is outperforming the US. This is a shift. Now, part of it is that we're getting change in trade channels. A lot of manufacturing that might otherwise have gone to China is moving toward India and Vietnam. We've seen the sectors that make up the Japanese market, a lot of financials, a lot of industrials perform quite well. But it's notable because once this starts, it tends to go on for some time, which is why we've been anxious to have a little bit more global exposure in our client portfolios. Taiwan has been strong over the last few months on the back of Taiwan Semiconductor. And certainly the TSX actually is performing well. It's actually outperforming the equally weighted S&P so far on the year, and we're trading very close to new highs. So in a sector, when more and more stocks participate, that's healthy, that's expanding breadth. When more and more markets participate in strength in an asset class like equities, again, it's strength. It's not just one market, it's broadening equity exposure that people are looking for. We take that as a positive for our equity position. So we like equities. Now, one of the things that we've been waiting for is a return to liquidity. I thought this was an interesting chart from the Bank of America Merrill Lynch, looking at the number of rate hikes per month. And June of this year was the first month since October of 2020 where there were no global rate hikes. And in fact, there was some rate cuts. So remember that markets don't line up with the economic data concurrently. They look forward. And when we start to see easing policy, it tends to be that markets like that. When we go to fixed income world, the world of bonds, we think we saw a generational low in rates in 2020, much like we did in the late 1940s. Bond yields very clearly changed their behavior from a series of lower highs to a series of higher lows, and that continues. When we look at the long end of the US bond market, it's still 49% off the highs in 2020 when we were at a generational low in interest rates. So you can see all the moving averages continue to move lower for price. That means bond performance is very poor. And we're now 4 years into the most significant bond bear market in the last 100 years. So this has been an asset that we've been avoiding. If we do a simple comparison of stocks versus bonds, the S&P versus the aggregate bond index, you can see there's a very clear picture. Stocks are outperforming. And even during 2022, when we had both stocks and bonds down 20%, bonds provided no real diversification. And in fact, if you were in dividend growth stocks, you did a lot better than the S&P or the aggregate bond index. So dividend growth stocks versus bonds, same thing. Bonds gave you no outperformance during the bear market, and certainly dividend growth is outperforming during a rising market. This is the dividend growth ETF RDVY versus the aggregate bond index. So this is all really important because our premise has been that when you get into a long-term rising rate period, and of course there will be pullbacks in yields, dividend growth tends to really outperform any other kind of income investment. When we go back to the early 1950s and 60s, as rates were going higher, bonds and inflation basically matched one another, about 1.6% a year. The S&P gave a 15% return a year because companies have the ability to raise price, and the best performing stocks were the dividend growers. Companies that were most able to grow their dividends every year. So this is a real focus for us in our income strategy. It's one that I think is working pretty well. If we go back to the middle of March of last year, as things started to broaden out, the aggregate bond index since then up 1.6%. 2.8%. If we look at the high dividend cohort of stocks, up about 18%. The Barometer income strategy up just about 30% over that period. So dividend growth is definitely attracting new investors. A lot of money is starting to migrate from bonds as people have sort of throwing in the towel. But these migrations take a long time. They don't happen overnight. They happen month by month, and they can go on for years and years, and we want to be there as other folks are coming in. Moving on from stocks and bonds, commodities. Well, commodities have resumed their move higher. This is the global tightening cycle, and over the last 4 months, steadily, the aggregate index of commodities is now moving higher again. If we look at commodities versus bonds, they're making new highs. If we look at commodities relative to the equally weighted S&P since 2021, commodities outperforming. So we think that this is an important asset class. Now, we always are trying to build diversified portfolios, and you build a diversified portfolio to manage risks. In a world of disinflation, one of the big risks is falling asset prices. So we own bonds to protect against that. In a world of inflation, you have a different kind of risk, the erosion of your purchasing power. And commodities have tended to provide a really good hedge against inflation, along with stocks. And we think this is why some money is migrating towards commodities. Now, certainly over the last many years, as commodities performed very poorly, not very much money was invested in new capacity. And now we wind up in a situation where we've got growth and demand for certain commodities to grow the power grid, et cetera, and not much new supply. So copper, which went through a very long bear market, broke out, consolidated during the tightening cycle, and over the last few months, again, moving higher. Well, of course, it's because of very little new supply coming on. And we know, especially over the last couple of months, just how much energy we may need to fuel all of the AI data centers that are being built to fuel this new AI boom. So certainly one that's important to watch. Also in the world of commodities is gold. And again, another hedge against inflation. This is the long bear market that gold went through from 2010 through 2019. And we've clearly broken out of that on the back of central bank buying. Now, China's been a big buyer. Russia's been a big buyer. China went out of their way to say they haven't bought any in the last 2 months. But India has been a big buyer. And they moved about 100 tons from the from the UK to their domestic vaults, building on their reserves. Now, seasonality is something that I don't spend a lot of time on, but I like to be aware of it. When we look at the gold futures seasonality, it tends to be seasonally July, August, September, October are quite strong. And we certainly have seen breakouts in both gold and silver. This is the silver over the last number of months from the beginning of the year, broke out of a long bear market on the back of just a shortage of supply. Now, we think about it sometimes in our terms, why do we need to own silver or gold? If you're in countries that have more difficulty than maybe we have, or maybe there's lots of money printing, you certainly think about it. We look at what's happening in China. These are the stock of silver in Chinese warehouses, and that's definitely in decline. There definitely is money being spent to protect against the devaluation of their currency. Agricultural commodities are firming up again. And when we put all that together, year to date, equally weighted S&P is up 4.7%. TSX up a little more than that, 7.5%. The aggregate bond index almost no return. Our income strategy is up 16%, focused on dividend growth. The equity strategy up about 16.6%, and our global portfolio up just about 9%. So in general, things are moving in the right direction by focusing in the right sort of macro areas. We don't have to be anywhere. Our job is to try and focus on the areas that are getting some benefit. So just as a reiteration, our job is to identify the parts of the market that are benefiting based on the economic backdrop. We always have to watch for change, signs that new areas are emerging as leadership or old areas are receding. In the absence of leadership, be willing to sit on our hands and do nothing. So this is quite a tactical approach. We're trying to do something to earn the fee that we get paid to manage money. We don't want to look like an index. We try to use our main tools, which are some top-down tools to identify where it is that people are putting money today, where there's a tailwind, identify securities within those areas that are both fundamentally sound and technically performing well in the now, because if you're in a decent market, you want to participate. And then we run a very disciplined selling strategy to carve out the ones that maybe don't work or we need to protect a gain. Because this portfolio is a living, breathing thing. We are reevaluating every position every day based on a set of rules. And those rules are trying to make sure that we are addressing the three things that impact return, getting to the right asset class. And right now that's stocks and commodities. We want to identify the sectors and themes within those groups that are most benefiting. And then we want to find securities to express our view. Everything is driven by this breadth-based model, trying to find areas of the market where we're seeing expanding breadth, where more and more securities are participating. And late in the cycle, we also want to recognize when, while the leaders carry on, the weaklings start to peel away. That tells us there isn't enough new money getting put to work in a particular part of the market, or there's enough money leaving where the risk reward levels change. And in that case, we need to tighten up our stop losses. We got to raise a little cash. We got to wait for a better opportunity. Okay, so here we are sitting in the middle of July. Technically, through the course of the year, the market has narrowed. In the early part of the year, 90% of companies were trading above their 50-day moving average. In March, 85% were. In May, 50% were, and that dropped as low as 30%. So that's something we watch. When I looked at the early part of June, you can see our short-term indicators and longer-term indicators had turned negative. They got a little bit worse midway through June. At the end of June, they started to show some improvement. This is actually this week. We've seen the percent of stocks with positive momentum reverse from 30% to 44%. That's a positive. When the market started to correct internally, that number was 90%. So we moved from 90% of stocks with positive weekly momentum all the way down to 30. In other words, the market stalled. The average stock stalled. Now starting to show some reacceleration. Percent of stocks hitting new highs versus those that are hitting new lows fell to a low level and has started to improve over the last 2 weeks. So we're watching that because, of course, we're coming into earnings season. This week, we start to see S&P 500 earnings. We start with some of the major banks. We know that the expectation is that estimates have been rising for what to expect through the rest of this year. And expectations for 2025 have been rising. And on the back of that, profit margins have been expected to rise. Part of it because of some of the efficiencies coming from AI, some of it coming from companies that are very powerful within their sectors and have the ability to set price. But now we find out the most recent report card. Companies are not in the market buying their own shares because they have more information than the average investor does. They have to go into a blackout period. And now we'll get the report card. Now you can see the earnings progression started to weaken in the third quarter of 22. So through the course, 21 into 22, earnings growth was weakening, and so did the stock market. The market bottomed in October of 22, looking 9 months out for the beginning of an improvement. And here we are in the second quarter of 24. And the expectation is we'll see 9% quarterly year-over-year earnings growth. And that's pretty strong. That number has been moving up. Now we're going to get the report card. We're going to see how companies do, company by company, sector by sector. So it's important to see what's happening in the market leading into this. Everyone's always factoring. So let's look at the leading groups. Technology has generally been leading over the last 2 years. We had a period of underperformance early in the year until April, but then tech was able to reassert itself. And this is the XLK made up of the largest heavyweight tech stocks, and relative strength has been rising since the beginning of May. And you can see the XLK today traded at a new 52-week high, closing just off the highs. Now, we talked a few weeks ago about dividend growth stocks within technology, and the relative strength actually turned up there earlier. Semiconductors, which are a really important part of technology and a really important indicator for the economy in general, made new highs today. This is the broad-based semiconductor index, SOXX, trading better than 94% of companies in the market. Now, we can say that companies like Broadcom and NVIDIA have run maybe ahead of themselves, or maybe the estimates are just too low. For the last 4 quarters in a row, NVIDIA has come in with significant positive expectations for their earnings and blown the doors off beyond that. We'll see whether they continue. But at this point, the stocks are performing really, really well, and the sector is performing well. And not only that, but this past 2 weeks, we saw the breadth model that we follow for semiconductors turn up and start to expand, meaning more and more semiconductor stocks participating. Well, that may also be a sign that some of the consolidation we've been seeing may be coming to an end, along with the improvement in the equally weighted NASDAQ 100. The communications sector, which largely today is made up of companies like Meta, Alphabet, and Netflix, made absolute new highs 2 days ago, trading better than 85% of stocks. And that's including carrying some of the telecom stocks that have been very, very weak. Financials. Well, it's hard to expect a very weak market when financials are making multi-year highs. This is the broad-based financials ETF, XLF. Each of these are months. So when we go back to October, November, December, January, February, March, April, May, June, here we are in July at new highs. Goldman Sachs today closed at a new all-time high, trading better than 91% of companies in the S&P. This is a company that's highly correlated to capital markets. Their success is based on the expectation for a healthy market and opportunities to provide financing. JP Morgan, very strong day today, up almost 2% coming into earnings, trading at a new high. Citigroup, trading better than 90% of companies in the S&P, up 2.8% today for a company that's a $127 billion market cap. That's a significant move. I don't think these point to market weakness. In Canada, the leader has been Royal Bank, made a new relative strength high today and a new absolute high. And then when we look at shares of the TSX, the TMX group, the company that owns the Toronto Stock Exchange, new relative high, new absolute high yesterday. So I think that's a clue. NASDAQ 100 equally weighted index breaking out of a consolidation, major financial stocks making new highs coming into earnings. That's not telegraphing people making a bet that things are getting worse. Outside of the banks, the property and casualty companies continue to chug along. This Fairfax Financial has been just a champ. Manulife has been a champ. Some of the others in the portfolio continue to perform well. This is a leading sector, and it's an important sector if we think that we're in a healthy market. Moving on, industrials. Now, this is a little bit more economically sensitive. You can see, much like the equally weighted S&P, the equally weighted basket of industrial companies has been consolidating since the beginning of April. Internally, there's divergences. The aerospace group has been quite strong, led by companies like Howmet, had a little pullback in the month of May and early June, turning higher here in the month of July. This has been really the leader in the defense sector. The waste companies like Republic Waste in the US, Waste Connections here in Canada and the US, making new highs. They're dependent on industrial production. It's a volume-based business, and the pricing has been very strong in this group. The mid-cap industrial companies that are selling product into the infrastructure build in the US are performing quite well. But on the other hand, the transports have been weak. Now, the transports now have an almost 20% weight in Uber, which is a bit different than the rest of the group. But I was noticing yesterday when I was doing a review after being away for a week, the rails in general have been weak over the last few weeks. The airlines have been weak. The truckers have been weak. And you can see the relative price performance of transports is something to be left lacking. So we're watching that. We don't have really any exposure here, but that's something that we keep an eye on. Materials similarly going through this consolidation, trading above support and below resistance, will go one way or the other. Again, it may be that the NASDAQ 100 equal weight is giving us a clue, but we got to watch within the group. We talked about copper 2 weeks ago coming down and testing the upward rising moving averages. Here we are 2 weeks later. We held at the moving averages and are moving higher. So after a 54% rally, they pulled back about 1/3, which would be normal. We held at the moving average and are moving higher. Companies like Southern Copper, very close to making new highs. Capstone is one of the mid caps we own, again, trading better than 90% of companies in the S&P. If we're headed for recession, probably they wouldn't be trading this way. Now, part of it is that supply and demand. Again, we've got demand on one side, we got supply on the other, and the supply is really, there's no response there. So it may be that that's what causes the squeeze. But either way, we think they have pricing power. Moving on to gold and precious metals. They've been incredibly strong since February. This is very strong rising relative strength. This is Kinross Gold, made a new absolute relative high today. Agnico Eagle made a new high, and Alamos Gold within a stone's throw making new highs, all seeing sharply improving relative price performance. So some of the areas of basic materials continue to act quite well, and this also may be a call on the economy. We've had a little consolidation in energy, but trading above all the moving averages. Companies like Imperial Oil within a whisper of new highs, they continue to behave well. So these groups all are hanging in really nicely, but there are some areas of weakness. Telecom, high dividend paying stocks with no growth, very close to relative strength, new lows. Consumer staples, boy, not such a good day today. PBJ, I think, is a apropos call symbol. This is the Invesco Food and Beverage ETF, falling relative strength all year long. Telecom and staples, they're pretty defensive. You'd expect people to want to buy those if we think they're headed into a weaker economy. Consumer discretionary in general has been weaker. We've talked a little bit about consumer discretionary and why we want to avoid it in general. Outside of companies like Costco, which just continue to chug along, Walmart would be the same, discount retailers. Healthcare, defensive in general, continuing to relatively weaken versus the market. Outside of some outliers like Eli Lilly and McKesson. And real estate continuing to be very weak. So all of these sectors are sectors that tend to do a little better in a different kind of environment. A higher yield environment. One where we're seeing a little bit more disinflation. When we look at the sector work, as of the 10th of June, the average sector had 42% of stocks in uptrends. The weakest groups here on the left of the distribution curve, meaning the smallest number of stocks performing well. And over the last few weeks, as the market narrowed, slowly the number of stocks in uptrends has been falling. But still on the right-hand side, you got financials, you've got technology, you've got some industrials. On the left, a lot of healthcare, a lot of consumer discretionary sectors, things that in general have been underperforming. So the market continues to really be bifurcated. We really have to pick our spots. When I came back and did my review yesterday, some groups continue to really stand out. And these are all companies that we own in some of the sectors that are leading. And on the other side, nothing really turning up. Transports, machinery, chemicals, fertilizers, consumer staples, auto, travel, restaurants, a lot of consumer related sectors, business services, have and have nots. So how does it shake out? Well, our largest weight continues to be financials. We mentioned that a month ago we got taken out of National Bank Financial, which had been one of our large holdings. When they made the announcement they were buying Western Bank at the price they paid, we thought was too much. Technology has steadily been growing a little in the portfolio, although we're not adding new positions currently. Energy is a significant overweight, as are materials. And at the other end of the spectrum, we've got real estate, consumer discretionary, utilities, communication services. We do own Google and Meta, but we don't own any telecom. And consumer staples continues to be a relatively small weight. So we have to pick our spots. Now, I know that the largest stocks are expensive, but we highlighted a couple of weeks ago the average company, excluding the top 10, the S&P is trading at about 18 times earnings, and actually estimates have gone higher for earnings since then. It's been highlighted. It's been a long time since we had a 2% drop. In fact, it's been 345 trading days since we had a 2% drop. But when you get into significant bull markets, you can go a long time between 2% drops, and they can come at any time. But right now, there's no sign of material weakness. There's no sign of concerns in credit risk. The extra return that a corporate bond investor is expecting versus a sovereign bond has in general been falling. So it means there's no fear about a credit event. Volatility continues to be very low. And we know that in the strongest cyclical bull markets, volatility tends to stay at low levels. So these are all things we're watching. We're watching the earnings, we're watching the internals of the market, and we're watching liquidity conditions. The rate hike cycle is over. Now we're into cutting. And we know in general that markets really like liquidity. Now we can get a correction at any given time. If you went back over a long period of time, on average, you get a number of 3% pullbacks, 2 or 3 5%ers over the course of a year, even a 10%er. Now I color that by saying that in a cyclical bull market, you don't tend to have as many of these. And certainly not when you're 4 or 5 months out of a cyclical bear market. You've only just begun a cyclical bull market. We should have some running room in front of us. So we might have some time corrections. We might have some sectors that don't perform. It's about picking your spots. It's about picking the right stocks. The best kind of market you can be in is where the stocks have low correlations to one another. In other words, they aren't all moving like a school of fish. There are good ones and bad ones, and our job as a manager to earn our fee is to pick the right ones, and then to manage the inventory on client portfolios. We think we're early days, having come out of this bear market, and we got a long way to go. There will be pullbacks along the way. There's going to be lots of noise around the upcoming election. It tends to be markets actually pretty good into a re-election year, but we know that there's going to be some uncertainty. If things get difficult, we'll get more defensive. That's what we do. But as it is right now, we think the right thing to do is to be pretty fully invested. We've got about 5% cash in the portfolios. Because breadth has been a little weaker, we haven't been putting on new positions. If we start to see improvement, that money will get put to work. And with that, let's take a look and see if there's any questions. Okay, Larry had a question. Did the guidance Corning put out help to cement Barometer's view on AI and semis? Look, there has been all kinds of evidence that things are moving very quickly in the world of AI, and that the demand for semis is strong. The market signaling is that breadth is now expanding in semis. And it's not just NVIDIA and Broadcom that are performing. Some of the analog semi producers are performing well. And certainly companies like Lam Research, which makes semiconductor manufacturing equipment, companies like Taiwan Semi that are big, fabs, they're all performing well. I think it's interesting. I looked at Corning today, 2 massive days in a row, probably the 2 biggest days we've seen since the early 2000s. We're going to take a closer look at Corning. Maybe there's something to do there. But I think that the aggregate of all of the news around these themes is that it's something that we really need to be participating in. We think that the job of a manager is to make sure you wind up in the road of the key themes that are driving market returns. And right now, clearly AI is one of them. Most analysts and commentaries seem to be projecting a lowering of interest rates. Do you still see a long reversal in rates upward, hence bad for bonds? So Bob asked this question about the path for rates. So let me just see if I can just put this slide up again to make a point. So this was the rise in rates from the late 1940s through 1981. This is 1981 through the low in rates in 2020. Look at this sawtooth action, right? Things don't go in a straight line, and they have pretty broad swings along the way. I believe that we are now in a period much like 1950 through 1966, 1970, something like that. And we do think that there are going to be cyclical swings. If you think that you're a good enough trader to capture those short-term moves down in rate, which means a rise in bond prices, that's great, and you should go for that. The reality is, though, that movement down in short rates should be even better for certain equity sectors. And when you look at this period in aggregate, stocks went up 15% a year and bonds went up 1.6. So I'm not saying that rates can't come down in the near term. My guess is the Fed will, from this point, cut rates a few times over the next 12 months. There is a slowing in the employment data. There certainly has been some slowing in manufacturing data, although there's reshoring of manufacturing coming to the US to help offset that. We just think that we'd be better off to own dividend growth stocks than high dividend payers or bonds. We think that the long-term tailwind for that part of the market is probably worth being there. I have a question on the CONY ETF, and I have to be honest, I don't know that one, so I'll have to take a look and come back to you on that. Any other questions? Nothing else from the chat? Okay, well, we're going to start getting information this week on the earnings picture. Most importantly, we're going to see how the market responds. In general, when the financials have reported over the last few quarters, they've had a little bit of near-term weakness off their report a week or two, and then found their footing and rallied. We'll see whether that trend continues. But we think that they're set up really well technically coming into it. We prefer the big banks with the great balance sheets versus the regional banks that have more commercial real estate exposure. It's going to be interesting to see how markets hang in the absence of corporate buybacks, which are blacked out during the earnings period. We've been in that period for about 10 days now, and market's been okay. And we're going to see whether we get any broadening or any narrowing in the market. So we'll be watching intently, and certainly ready to make change if it's necessary. But as it is, we've been pretty pleased, given the fact that the market's narrowed, that our stocks have held in really, really well. And that's a good test for a portfolio when you go through a period of a month or two where the market narrows and where the market churns around a bit. The strongest stock should hold up the best, and our portfolios have held in really well. So I want to thank everybody for tuning in, and don't hesitate to reach out if you got additional questions. You're too shy to ask during the webcast. One of the great things about being a firm where we only take care of about 250 families, we've got capacity to talk to our clients and answer questions as they come. If anything's on your mind, please don't hesitate to reach out. And otherwise, come back and visit with us again next Tuesday at 4 o'clock, and we'll see what's happened between now and then. Have a great week.